You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the Options Insider Radio Network for you, the busy financial advisor and asset manager who's trying to learn interesting ways to incorporate options into your clients' portfolios, as well as for those of you out there maybe who are thinking about adding a financial advisor or looking for a financial advisor who might utilize these products in some ways they may want to use them. My name is Mark Longo from theoptionsinsider.com, coming to you from our Options Insider Radio Network studios here in the options mecca of the known world, Chicago, Illinois. And we produce a wide array of fine content over here at the Options Insider Media Group, not just this program. And you can find it all. Probably the best place, the one-stop shop for you to do just that is surfing on over to theoptionsinsider.com. Of course, you get breaking news on the options market, education, analysis, unusual activity, a lot of great stuff over there. And then while you're reading, click on that Insider Radio Network tab, and that'll get you over to the full array, 13 programs on the old network, including many, many archived episodes of this program, The Advisor's Option, for you guys to download or stream at your convenience. Of course, you can also find it in all the major outlets, iTunes, TuneIn, Stitcher, etc., even in the major app stores, iTunes, Google Play, all the app stores, even the Amazon Fire app store. And of course, while you're listening, while you're streaming, we'd love to hear from you guys. Send in your questions, send in your comments. You're the reason we do this program after all. And joining me on the old program today, my usual partner in crime here on the old Advisor's Option program, beaming in from indeed scenic and sunny. I could say that about Chicago, but it's not really true this time of year. But it is true in his neck of the woods over there in Puerto Rico. He is Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the Advisor's Options program.
It's great to be here, Mark. It's as usual, it's sunny and 82.
Should say Happy New Year, too, and this is our first program of 2016 here, so Happy New Year to you and the whole Swan crew over there.
Thank you. We look forward to a very very entertaining and enjoyable year in the markets.
Yeah, well, it's off to the races so far, and we'll get into that. And speaking of the Swan family, we have an additional member of the Swan team joining us for our next segment. It's time to get into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, welcome to the Buzz. This is the portion of the show where we break down some of the interesting developments and research and new findings and new stories and breaking news in the world of options and indeed in the world of financial advisors that maybe you missed. You guys are obviously out there pretty busy managing your different client accounts. You have a lot of other things you have to pay attention to, let alone the latest breaking developments and research and studies from the world of options. So we do it for you here at the little segment we call The Buzz. And to help us do the segment this time, we're welcoming on a new guest to the program. He is Mark Odo, Director of Investment Solutions over there at Swan Global Investments. Easy for me to say, Mark. Mark, welcome to the program.
Thank you. Great to be here.
And Mark, as we are wont to do with all of our first-time guests here on the old program, why don't you go ahead and give us a little bit of your background in the options and derivatives markets and how you found your way over there to Swan?
Sure, I'd be happy to do so. Well, I've been with Swan Global for just over a year now. Prior to that, I was with Zephyr Associates, the software provider that does performance analytics. Prior to that, I was with a mutual fund company, and prior to that, I was a registered investment advisor working with both retirement plans as well as high net worth individuals. So a little bit of everything, a little bit of exposure to all sides of the industry. One of the things that really drew me to Swan Global Investments was their ability to offer something different. Having worked at Zephyr Associates as their director of research for 11 years, I saw just about everything under the sun, all the long-only strategies, various hedge funds, people on the other side of the business, financial advisors, financial planners, and so much of it was similar. It was just cookie-cutter type stuff. And when I knew some of the people working at Swan and started some conversations, and the more I learned about them, the more I thought they had something really unique. And it's been great. I've been learning all sorts of new stuff, and been producing lots of different blog posts, white papers, research, intellectual content to help promote the idea that options are really going to be the tool that you need facing this environment that we're in.
Yeah, if you found yourself surfing on over to the Swan website, listeners, and reading some of the interesting content they have over there, either on their blog or some of the other papers they put out, chances are Mark's the guy who wrote it, so you may already be familiar with some of his work here. And what we thought we'd actually touch on today was some interesting work that really ties into the evolving nature of the client for a lot of the advisors out there. We all know baby boomers make up a large percentage of the clients for many of the advisors and asset managers out there, and that audience is, shall we say, evolving a little bit. They are shifting. A lot of them already have, but now we're seeing the bulk, the lion's share of them starting to shift into those retirement years. And that poses a lot of interesting challenges and a lot of interesting new opportunities as well for the advisors out there who service this audience. Because traditionally, these are people who came to them and they would get their performance in whatever, they probably would break them down in a 60-30-10 type account, and they would compare their performance to the S&P. And it was all about, capital gains over that time period, maybe a little bit of income mixed in there as well, and maybe a dollop of diversification to some quote-unquote non-correlated asset like an oil or a gold or something like that. And we all see how well that's working out now, but that's a conversation for later. But as this demographic is now shifting and evolving into the retirement years, that poses some interesting conundrums for the people who have to still manage their assets and their funds. And Mark, you kind of really took a deep dive into this recently over there at the Swan website, and encourage listeners to go read it for yourselves. The paper is called The Retirement Conundrum: Untying the Gordion Knot. And rather than have me surmise it for you, Mark, why don't you go ahead and give a rundown of our listeners of exactly what you were discussing in this paper, and then we can get into some of the findings.
Sure, you bet. Well, when the conversations we've had with these various financial advisors, financial planners, financial consultants out there, there was lots of concerns they had, lots of challenges with their client base, these baby boomers who are tipping over into the distribution and capital preservation stage rather than being in the accumulation stage. And what we thought when we looked at this is that all these challenges were individually pretty significant, but What the problem is that we're facing all these things together. We've got half a dozen or more things that are all tied together in this big knot. And individually, these problems are challenging, but collectively, they almost appear insurmountable. One of them will obviously be the decreased role of public and private pension plans. Everyone these days is expected to do it yourself with qualified plans. The onus is on the individual to be prepared for the retirement. There's, of course, increased longevity risk. I mean, it keeps going up and up. I think we're into the 80s as far as life expectancy for the baby boomers. As far as the current environment is concerned, we've had a tremendous bull market and bonds that have gone back 35 years. Yields are at all-time historic lows, so it's very hard to get income out of the 60-40 portion of the allocation. Of course, stock markets are very volatile, and the stock markets have been on a 7-year bull run here. So where do you go? Now, in addition to that, there's all sorts of different curveballs. We are in the distribution stage where the retirees are going to be taking money out of that pool that they've hopefully saved up over a good 10, 20, 30 years. And really, they can't face another bear market without having to have very dire consequences on their welfare. And, of course, there's just the bad luck of it all. I mean, if you got your timing is off, if you invest at the wrong time, it can have also an extreme impact on your final wealth. So collectively, all these things are tangled together. And the reason why this particular paper is called the Gordion knot is it ties back to a historical episode there where Alexander the Great was presented with a challenge. There was a knot that was unsolvable. It was this big bundle, this big tangled web, and for centuries, no one could undo it. And the prophecy was whoever could undo the knot would become the conqueror of all Asia. And so Alexander the Great, he tried the same kind of true means that everyone else had done before, where he tried to pull out one end of the knot, pull out the other end to untie it, and he just couldn't undo it like no one else had done it for the last century or two. So he took a step back, took his sword out, and just chopped the knot in half. And the reason why I like this is it illustrated two things. It illustrated innovative thinking and bold action. The same methods that everyone had used for centuries have not been able to solve the puzzle. But Alexander thought outside the box and in a way that no one else never thought of before. And his solution was the right solution.
Yeah, you outline a lot of interesting, disturbing trends. And you're right, in and of themselves, each of them is disturbing. When they're taken collectively, it kind of is a little bit more shocking. You're right, people are living longer, so they need more money to be able to sustain that lifestyle for decades longer. Now they also can't really rely on that one job they had for 40 or 50 years to provide them their pension when they retired, like most of our parents and grandparents did. That's kind of gone the way of the dodo. So it's your own IRA, it's your own 401k. It's kind of roll your own these days in terms of doing your own retirement savings. Also, you're right, the large portion of a lot of these income portions of these portfolios, which has been around 30% for a lot of these and probably will be shifting to larger components as these people move into the retirement stage. There really isn't a lot of income to be had in the traditional sources, not the kind of stuff we talk about here on this show, obviously, but in the more traditional sources of just investing in fixed income vehicles or even dividend yield type names and things like that. Of course, and now you compound it with the notion that maybe we're teetering on the brink of a correction, recession, drawdown, call it what you will, bear market here. That could probably be maybe a time when some of the boomers out there are a little bit reticent to want to actually withdraw some of those funds because they're taking they've lost some of the appreciation they built up in that account, and so maybe they wish they did it earlier. They probably couldn't because they were restricted, et cetera, et cetera. And one of the reasons why we talk about hedging and IRA so often here on this program because it's such a big issue, and so there's a lot of different things to work with here in terms of all these different factors kind of coming to bear at the marketplace at once. And I'm guessing in your paper here, Mark, you have some proposals for how to counter that.
Yes, certainly. Well, usually what I do is when I talk to these financial advisors or I'm giving a talk or a presentation, I ask for a show of hands. I ask people, who's more worried about the bond market and who's more worried about the equity market. And I do that partially for my own curiosity, but it's interesting. I mean, it's usually split 50-50. I think you can make a very strong case that either side of the traditional 60-40 equation is very perilous right now. I mean, the bond market is out of gas. Yields have fallen from 14% 30 years ago to about 2% now. And as a result, when yields rise, it's inevitable that bonds are going to fall. It's hard to get income out of any traditional bond products. And as a result, people have gone into more exotic bonds, whether it's emerging markets, bank loans, bonds, multi-asset class bonds. And the problem is that those things have not fared very well when financial crises have come along. High-yield bonds, any type of non-investment grade debt have almost equity-like characteristics during a downturn. So certainly people are justified in being concerned about the state of the bond market. Of course, the flip side of that is the state of the equity markets. And certainly since 2016 has started, we've started to see some of those fears come to fruition. I mean, U.S. markets are near all-time highs. This is the third longest bull market in history. Market leadership is very, very narrow. You hear about the FANG stocks essentially driving all the returns in 2015. And it's starting to come, possibly unraveled here in January. So really what we propose here at Swan is you have to do something to directly address the downside risk in the market. You can't just expect to diversify away the downside risk by investing in things that people traditionally have done, like international stocks. You mentioned commodities, gold, oil, and stuff at the outset. You look at your Bloomberg screen, you're seeing quite a bit of red these days across the board. So really, Swan's philosophy has always been the best way to address market risk is to address it head on. And to do that versus using put options. I mean, we use long-term put options. We ensure the notional value of our portfolio by investing in something which is inversely correlated with that of the market.
Yeah, we see a lot of talk, and we've seen a lot of talk for years about, having that portion of your portfolio allocated to something that provides that quote-unquote inverse correlation. And the reason I use quotes there is, like you said, we're seeing a lot of this right on the screen these days. So if you were looking to some of these supposedly non-correlated assets like oil, it's been a bad ride for the past year for the most part for you. If you were relying on that was moving down even as in recent days as your portfolio has been selling off. So that's not the kind of thing you like to see from your supposedly non-correlated asset. We've seen some talk about volatility as an asset class in and of itself. And there's some back and forth as to whether or not that actually is the case. But, if you want that volatility component and you actually want true inverse correlation, you're right, Mark, the put is still kind of the only game in town. You buy that put, you know what you're getting. You have a delta, you have that volatility component as well. So you kind of have a bit of a double whammy there. And it's the only way you can really, at this day and age in the marketplace, kind of guarantee that inverse correlation versus everything else, gold, commodities, they're kind of unreliable. Fixed income, like you said, has a lot of other issues there as well. So if you definitely want, that's what you're looking for, the non-correlated or the inversely correlated, I should say, asset, then the put is kind of the only game in town. And Randy, I know you guys over there at Swan, you've kind of built your entire business around that put and managing the put and then taking some other steps to help pay for the cost of that put. And it's a full-time job, as we've seen. There's a lot of effort in there, but that's kind of been the starting point for you guys. And I imagine now this kind of resonates with you that the put is kind of one of the real answers to this solution that's facing a lot of advisors out there when it comes to how to handle their clients' portfolios as they move into the retirement era.
Well, I think the problems that we see that Marcus describes in his paper is really a long time coming. And this has been building up, I would argue, over the last couple decades, all the way from the late 90s and the irrational exuberance of the dot-com bubble. And that popped at some point in probably 2000. And then the government decided, hey, we've got to do something to kind of goose the economy, which led to the next bubble of probably a real estate bubble that we had, and so on and so forth. I mean, the game has always been try to fix it and prevent, any type of downturn in the economy from occurring. And of course, that's caused problems. The unfortunate result of some of the things the Federal Reserve has done over the last couple of decades is ultimately sacrifice the fixed income markets, which of course, as we talk about the aging of the population and how retirees traditionally have relied on fixed income products to provide some income as well as some capital preservation when the equity markets are not doing so well, it's really kind of left them with out with one of their solutions. So of course, that's probably forced people into staying in a more equities and more risky assets. So yeah, as you guys have talked about, I mean, Swan's solution since the very beginning and inception of our strategy was saying, hey, there's a better way to manage market risk. You really can't diversify that away. And you do that by buying assets that are inversely correlated, that you know are going to be inversely correlated. And so, yeah, that's what we've spent almost the last 18 plus years in trying to solve this problem and find solutions that really protect our clients, that really, quite frankly, can't go through another 30, 40, 50% sell-off when you're near retirement. So I think all of this is kind of coming to a head, and getting into the economic issues right now of I think maybe the Fed, or maybe not, the Fed has caused some of these problems by obviously starting to raise rates, but that's something I think we maybe talk about a little later in the show.
I'd imagine right now this is, obviously these are rough times for people. We're in kind of the roughest start to the year ever in the history of the markets that we've been keeping records in the modern history. This is certainly the roughest January on record, and so this is red on today being the one exception. Obviously, a little bit of a rally today, but aside from that, red pretty much on the screen every day in most of the major asset classes. But I imagine for you guys, Randy, this is actually a decent time. I mean, no one likes to see people lose money, but at the end of the day, this is kind of a good argument for kind of what you guys are doing, that providing that inverse correlation, providing that hedging, in these kind of markets. This is where kind of the advisor, I feel, really earns his keep. This is what your job is. Anyone can kind of just put money in a bull market and let it ride and then claim to be a genius when it works out. But in these kind of markets, when they're choppy, when they're turbulent, when they're frothy, and in these days kind of very much leaning to the downside, that's when the advisor has to earn his keep, and you could go all the cash and just kind of put your head in the sand. That's certainly one alternative for some people. But also you could keep your skin in the game, but also have some protection at the same time. So I'd imagine the phone's probably ringing pretty actively over there at Swan these days, Randy.
Well, yes, of course, our strategy is based on the concept that you have a full market cycle. That means that bear markets are regular events that occur, in some level. I think the average bear market's about every 3.5 years and about 35% sell-off. So absolutely, it's all part of the story and the strategy and how we designed it. Something that's going to be an all-weather strategy, not necessarily, looking for, super bull markets or multi-decade bull markets that existed in the 80s and 90s. So yeah, our solution traditionally has been focused on that fact that we try to set up clients for winning by not losing, and so it just always comes down to the right combination of upside and downside market capture ratio ultimately determines. Of course, we're not out here necessarily shorting the market or even profiting from the sell-off, but once again, it's really about trying to minimize your losses and having the right combination of assets in your portfolio that are going to, allow people to sleep at night and provide for their retirement without. When a bad year comes by that says this will change my retirement, that's something we would like to make sure that all advisors can not have to deal with that on a regular basis, which unfortunately, could be what we're seeing the start of right now. Markets obviously are still gone up substantially over the last 6 or 7 years. So, it's maybe on some of the international equity markets, we can argue that we're in a bear market. I guess we're not really totally sure as it's defined by a 20% sell-off in the U.S. markets at this point.
And Mark, since this is your paper, before we wrap up our discussion on it, any last thoughts you want to leave our listeners with, any last takeaways before they go and surf on over and read it for themselves? Of course, it's called The Retirement Conundrum, Untying the Gordion Knot. You can just put that into your Google machine, listeners, and you can find it for yourself. But Mark, any last thoughts on this paper and how it might interest our listeners?
Yeah, perhaps one more, Mark. You asked about the role of the advisors, and this is where they really earn their keep. One element to the paper is this move towards one-click solutions, things like target date funds, life cycle funds, or robo-advisors. And I think that's a mistake because most of those portfolios, at the end of the day, I'm an investor guy, and I care about the investments. And I certainly understand the appeal of having one-click solutions to make it easier for the investor. But at the end of the day, the investment solutions that you're getting out of those things are really pretty subpar. One element of this paper is we look at the allocations of various vintages of target date funds, and 90% of their assets are either in equities or bonds. And we already kind of touched on some of the challenges that both equities and bonds are going to face going forward here. And yet, that's where the vast majority of this $1 trillion market is in either just your plain vanilla equity or bond. And if you look historically, going back over the last 18, 20 years or so, the average return across virtually all the vintages of target date funds, from the most conservative to the most aggressive, are right in the 5% range, which is pretty underwhelming. The most conservative and most aggressive, they're all right there, right around 5%, average annualized over 20 years or so. Of course, robo-advisors are what people are talking about all these days, but the kinds of portfolios you're getting there really aren't doing anything to address systematic risk either. So, yes, I agree with your point that this is the perfect time for a forward-thinking advisor, someone who's bold and innovative. This is a time where that type of advisor should really shine.
Well, let's get into that a little bit then, too, like the current market environment, because I don't think anyone on our last episode, when we last gathered here together on the Advisors Option Program in the end of last year, was getting into the holiday season. Things were kind of winding down from a market perspective. No one really anticipated any major developments, at least until earnings, and probably even earnings being kind of a bit of a lackluster period. So it seemed like it was going to be quiet seas, quiet sailing on the near future there in the markets. And pretty much how we were wrong. Right out of the gate from the first trading day of January, the market was roaring to the downside for the most part. There were seemingly regular systemic shocks coming out of China and the Middle East and North Korea, and then the Fed rumors and everything else pretty much every other day. So to the point where we were 1% to 3% moves on almost any given day. We're pretty much becoming the norm. Volatility elevated across the board, the VIX gapping into the 30s. I think there was a brief period. It was kind of a bit of an aberrant print, but it did a print, I think, briefly. Let's see how high I got here. Yeah, I was getting to the mid 30s or so. About 32 was the high. And then, of course, but that, speaking back to the correlation we were talking about before, volatility across asset classes is spiking, out in crude oil, for example, products like OIV, which measures essentially the VIX of the big crude oil options out there, spiking over 70 after having vacillated around the 40-odd handle for the better part of the last quarter into the 50s, spiking up over 70. OVX, which is the volatility of the USO oil ETF, a popular one out there with retail and a lot of financial advisors. That one also spiking into the 70 range. So volatility up pretty much across the board. As we're recording this now, it's come off a little bit, but VIX is still elevated in the mid 20 range, and volatility in the commodities is certainly elevated as well. Randy, I don't think any of us anticipated talking about this on this first episode of the new year, but it kind of merits a little bit of mentioning here on the program because it is just so top of mind, I'm sure, for a lot of our listeners right now, just exactly what is going on in the marketplace and all this back and forth, all this froth, all this volatility, how it's really coming back to impact them from an options perspective and what that means if you are using options. You guys are obviously out there every day managing this DRS portfolio where you can actually, of course, use the puts and the calls and the put spread, et cetera. So, walk them through a little bit about what you're seeing right now and how that's impacting the execution of the strategy and maybe some interesting takeaways you're seeing from these markets. Because we said right now, obviously, these are good times for you. Some people want to call you guys, but doesn't mean these markets aren't difficult to navigate sometimes. So any interesting takeaways you're seeing right now from the marketplace and what your guys are getting from your trading team as they're trying to implement this strategy in these ever more turbulent markets?
Well, that's a very good question to ask. I mean, I would approach it maybe in a couple of different angles. I mean, from a business development perspective, obviously market volatility is good for our firm. Long term, where we spend a lot of energy and effort, which is one of the reasons why Mark Odo's on the team right now, is to really help us evaluate problems and solutions and be able to communicate that, because that's really one of the biggest problems you always have is you have a strategy that you think is going to work and it's going to work well over a full market cycle, and that means that we're trying to outperform the market on an absolute risk-adjusted basis. But obviously, when you get into the nuances of how your strategy performs over any particular period, you may have a lot of misconceptions and misunderstandings of how your strategy is really supposed to work. I mean, conceptually, obviously, people think a hedge strategy should pretty much always hedge. And of course, it's a little more complicated than just assuming that just because the market goes down, what type of protection are we going to offer over a certain level of the market? What is a short-term volatility spike or a decline in volatility? How does that affect our income trades, et cetera, et cetera? So, that's one of really one of the obstacles we have at Swan is to set up a program, educate our advisors and our clients so they understand and can stay the course to hopefully reap the long-term long-term benefits of a strategy such as ours that has proven over the last 18 plus years that provides value to the clients, not only from an absolute return perspective, but a risk-adjusted perspective. So I think that's really is setting the standards. Obviously, we like and we think that going through bear markets provides longer-term returns, higher returns for our clients. That's very hard to explain that to a client and make them understand how it seems like we seem to be rooting for a big bear market. But as we use the analogy in a forest, occasionally you need some forest fires to have new growth. I think that's really what we need. And I would argue that we're 6+ years into a bull market. We're long overdue. So we're pretty excited about the opportunities and challenges we have going forward.
And you're right, and hopefully people have been listening to this show for a while and they're starting to implement some of the things we've been talking about here, something even as basic as just buying a put, and then, of course, if you want to get more advanced into the put spread, and then writing calls, et cetera, and using collars and the zero-cost collar that we've discussed on this show in the past. And if you've been slowly embracing those strategies and those ideas in your portfolios over time, then this market environment, as turbulent as it may be, really won't be too much of an issue for you. And of course, if maybe you've been waiting for your moment, you've been trying to wait for something to point you in the right direction, say, hey, those guys on that show, they kind of know what they're talking about. Maybe I should try out these options things they're always going on about. Well, maybe the current environment, I can't imagine a better advertisement for the efficacy of options, maybe putting them on before all this happens. But still, going forward, certainly the use case of hedging and indeed of trying to find ways to implement that hedging is interesting stuff. And since we are in the buzz segment, before we wrap up this segment, we do like our data here on the program. And one of the areas that I've certainly been curious about for a while in the marketplace is the impact of weekly options. We've seen just an explosion of interest in short duration options contracts. Certainly over the past 2 or 3 years, it's kind of really just been a steady ramp up in those products. So much volume is migrating into these things, and even big institutional products like SPX, ton of volume going up in the SPX weeklies now. VIX added weekly options recently. Most of the major big equity options you may be trading out there like Apple and Google, et cetera, all have weekly options out there. So weeklies are, if you had to name one overarching trend of the past couple of years in the options market, it certainly is the trend towards short duration. But surprisingly, in spite of all that interest, there's been not a lot of data kind of backing up what the impact of that has been, or even the efficacy of some of the approaches out there. And so we're seeing some of the first data on that now. The one we saw right before, actually it's kind of breaking, right before the show started here, is a study coming out of the SIBO. Of course, they of VIX and SPX fame, but they have a few other indexes floating around out there. They have one which is the buy right index, which is, of course, writing calls on the SPX at the money calls, and kind of the opposite of that in some ways is, of course, the put index, PUT. And they write monthly at the money puts out there. And if you're interested in the PUT, by the way, I encourage you to check out the full episode we did on our Volatility Views program on this network a couple of years ago, where we really went into a deep dive with the creator of that index and kind of talking about some of the interesting nuances and why that outperforms the BXM, the covered call index, even though they are essentially and structurally very similar. But that's a conversation for another day. I encourage you to download that and listen to that. It's a very interesting one if you're interested in that sort of thing. But we have some interesting new data now, and not just so much about the PUT performance. That's not really what I'm getting at, but more about the change of and the efficacy of moving to the weeklies. Because I know a lot of advisors out there, we've heard from them and talked to you guys, and a lot of your clients as well are interested in the income component. And so we've talked on this program and others about, the different ways you can structure that income. But in general, the trend, the more effective it is if you move it closer to the actual expiration cycle. If you're writing a 1 month call versus writing a 1 year call versus, let's say, a 1 month call, the difference is going to be marked if you do that 1 month call 12 times throughout the year. Well, now flip that to the weeklies, and now you're doing that 52 times a year. So what is the impact of that? And we have some data on that finally. First off, as you might assume, given the fact that you're writing more options, each individual write is going to be smaller from a net income perspective, but overall, over time, annualized premium that you're actually generating from this strategy, and the data in this study goes back to 2006. So 2006 to 2015, the average annual gross premium they got from the regular monthly index was about 24% versus nearly 40% for what their weekly version of that. So taking that same strategy, writing that S&P put, I think, at the money, and just moving it up to a weekly format, doing it 4 times a month as opposed to 1, they had a markedly better performance in terms of generating actual premium. And again, the individual trade smaller, but net aggregate, you're making more. And now you might say, well, I'm writing puts. It's very risky. Actually, ironically, they found that by doing this, they actually had a lower standard deviation even than the regular monthly put index, which is kind of interesting, especially in the market we're in now. A lot of chop to it, a lot of froth in those waters. Seeing a lower standard deviation for the weekly put versus the regular put index, kind of an interesting one. Also, maximum drawdowns lower, down about 24.2% for the weekly version of the index versus about 33% for the regular, and about 51% for the S&P itself. So actually, even though you're writing puts, it has this inherent connotation of being very risky. The drawdowns were actually less, and even less than the monthly version. Also, it had the highest long-term returns over the total return of all these different indices, and they looked at a bunch of them in that period from mid-86, so that includes the crash of 87, in case you're saying to yourself, hey, there's no major sell-offs in this. And, of course, includes 08 and 09, which were market down years in the market, 01, 2000 as well. So there were some significant sell-offs in that period, 86 through 2015. Actually, total return for the put index was about 1,622%, which is surprisingly high. That's versus 1,500% for the S&P 500 and about 650% for the Citigroup 30-year Treasury Bond Index. So interesting stuff there. Also, standard deviation, monthly drawdowns, a lot of good data. I encourage you to check it out. We have it linked on the Options Insider if you're so inclined, or you can find it over there on the SIBO. Why it's effective in the long run is really because people really they really jack up those premiums in those S&P puts. And so if you're writing those consistently, it's a way to generate a decent amount of income for your clients, particularly if you as the advisor say, hey, my client wants to get long this particular index. Using the put as an entry point is certainly a good starting point, because at least you're getting paid and you're harvesting some of that premium. And this also works, Randy, for, I think, kind of flipping that script a little bit to what you guys do and what a lot of our other listeners out there do, which is, of course, the covered call. The covered call is kind of the flip side to the short put. You guys are obviously writing your calls regularly through the DRS as a way to offset that put. I'm kind of curious for you guys over there. I'm thinking probably, like we have been, kind of waiting for some more data to come out on the weeklies as well. Does this data, or maybe some of your own findings, has this led you guys to maybe start thinking about perhaps migrating the income portion of the DRS, the covered call portion, into more of the weeklies, or are you still kind of looking for more data on this, you think?
Well, actually, we're in the process right now of developing our own proprietary backtesting software that will use that kind of data to be able to, just throw out and try, hundreds, if not thousands, of different variations. So, generally speaking, though, I would always believe that the shorter duration of the option probably has more juice in it, on an average daily basis. And so it doesn't surprise me that you're getting those type of results. I mean, I guess it always comes back to, can you stick to that strategy in a year like 2008 when the markets dropped so much? I guess that would be one of the potential problems of a strategy like that, whether or not you can stay the course when you look to be trying to catch falling knives.
Yeah, that was your only strategy you had in your portfolio. You're right. That might be a rough call to have with a client in those years when the market is melting down. But, I think taking this kind of data and applying it to other areas, like indeed the covered call, which a lot of our clients or a lot of our listeners use with their clients, I think is an interesting way to do it. Of course, the flip side of that, a lot of advisors always write to us, say how busy they are, which is why they tend to write only quarterly or perhaps maybe monthly options for their clients. But if they do have a little bit more time and they can apply this to their clients, then essentially it does show the data is pretty undeniable. Mark, I know you do a lot of the content over there at Swan. I'm sure you're always intrigued by some new data coming out as well. Any thoughts on this in regards to not just maybe the weekly put right, but more even the evolution and the impact of the weeklies on the marketplace going forward, as well as what you guys are doing with them over there at Swan?
I don't have anything specific to add on that front, although I should add that we've added some really smart traders to the team who are exploring these types of new strategies, and hopefully people like Chris Houseman can join us on one of the future calls.
Yeah, certainly no shortage of interesting data, I'm sure, to come here on the weeklies as we see them really impacting a lot of different products, not just SPX, but VIX and the big equities, and even getting out into the futures options realm. Most of the big futures options products now have weekly components as well. So it's definitely the trend as liquidity is migrating toward that area of the curve. It may become a more attractive area for a lot of our listeners to play in as well. And we'll certainly keep our eyes out, listeners, for more data on this front. I'm sure there's a lot more studies to come on this. But meanwhile, it's time for us to include you guys on the program and time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Like the man said, it's time for the office hours, the portion of the program where Randy and I sit down to answer some of your questions, some of your comments about the world of options and financial advisors. Going to kick things off with a question from James M. He writes, "Hey, I'm watching my trading screens this earnings season, and I'm struck by my need for extra hedging in my portfolio." Well, I don't think you're alone in that case, James. He goes on to write, "But when I look at the prices for protection for names like Apple going into earnings, the cost seems prohibitive. In your opinion, is it worth paying the additional earnings premium for protection in these volatile periods? Do you have any strategies to mitigate the cost of this protection?" Well, this one, certainly timely. Apple earnings having just come out the other day, and that stock taking it a bit on the chin of late. So maybe our friend here, James M., is already perhaps wishing that he had paid up for some of those puts. But in general, we get a lot of these questions around earnings time. Some of them seem pretty salient. And when I saw the paying for the put, Randy, I immediately thought of this program, because that's kind of what a lot of what you guys do over there in the land of Swan. I don't think people really, when we talk about on this program and some of our others, about hedging and things like that, it's not just going out and, hey, just buy a put and then hope for the best. That's you could certainly do that, but you'll be paying a substantial amount for that protection over time, and it's really going to eat into your client's portfolio, which is why people go to such extraordinary lengths and take some interesting strategies and construct approaches to try to offset and mitigate the cost of that protection. So hence all the things we're always talking about here with the overlays and the collars and the different types of ways you can pay for that. So, Randy, I'd imagine you have a few thoughts on this topic, maybe not so much as it pertains to Apple, but in general, the notion of what you guys, all the steps you guys go through. At the end of the day, most of the DRS is about paying for that put. So why don't you run down for our friend here, James M., the different hurdles you guys jump through to offset that protection?
Well, I guess the long-term view for us at Swan is it is worth paying for the long-term premium protection, but I can't obviously address Apple at a certain point in time. I would argue that if you're that concerned about Apple during a certain time period, to buy insurance at that point in time may be good as a one-off, but if you're saying to do that consistently every time there's earnings, I think that would probably be a loser. But yes, there's a lot of different ways to mitigate the cost that you have. Our presumption at Swan is that the cost to hedge your portfolio over a full market cycle is really not as bad as everyone makes it out or seems to think. But of course, you've got to be able to stay the course and go through a full market cycle, which a lot of times is hard for people to do. But yeah, there's a lot of other strategies that mitigate that cost. We've talked about it, doing a collar, selling some out of the money calls, doing a put spread in terms of not getting protection all the way down to zero, but some level of protection where you could sell another put, lower strike price than the put you're using to protect the portfolio. All those types of things we do at Swan, typically on indices, not necessarily individual securities, but the concepts are the same. That's kind of my view on doing something like this. You just really have to decide what game you're playing. I think that's a big problem for a lot of people when they jump back and forth in terms of what game they're trying to play. If you know what game you're playing and then you design a program to put you in a position to actually succeed in that game plan over the long haul, that's been always my best view on how you win over a full market cycle.
Yeah, obviously it is very frothy right now in the earnings season. And we've said many times on this program and others, if you're just diving in and paying that earnings premium for these names, it's usually very difficult for that trade in and of itself to break even. You probably want to look at establishing those things ahead of time and taking some of the other strategies we've said before to really to try to mitigate that. And of course, we've talked before about doing things leading up into earnings and then taking them off so you don't have to deal with the turmoil, the tumult that is the actual earnings event itself. But in and of itself, if you're asking, hey, should I dive in and just buy a bunch of premium going into earnings? Usually the answer is no. But that said, there are a lot of strategies we've outlined in the show. Like Randy just said, look up the zero cost collar, one good way to try to do that, or indeed the collar by itself, if you're willing to pay a little bit for that protection, structuring that collar in a little bit more optimal way, longer term on the put, shorter term on the call, like we just saw, maybe into the weeklies. It's a good way to go over time. All right, next one up here is from J Valerio 1. He or she writes, the robots are invading the advising space. He's a little histrionic here. He goes on to write, I know a few of my colleagues are concerned about these services cannibalizing their business. What are your thoughts about these services and robo-advisors when it comes to options? Is this an issue with these products as well? I know this has kind of been, if we talk about the trend toward weeklies in the options world, there's been a trend in the advisor space, if there's been a story that's dominated the marketplace for the better part of the past couple of years, it has been indeed what he's talking about, the invasion of the machines into the realm of options. And if you're one of those advisors we were alluding to at the top of the show where you're 60-40 or 60-30-10, and that's kind of all the value add you're bringing to the table for your clients, then yeah, I'd imagine your gig is probably in danger by a lot of these automated services that can do approximately the same thing you're doing for your clients. So I think regardless, we are moving into this realm, this era where advisors are going to have to provide a little bit more service for their clients just to make themselves stand out. Of course, that also goes back to the trend we were talking about earlier with Mark's paper and the retiring boomers. They have different objectives now. You can't just stick them in the spreadsheet and say, okay, you're done. You have to really do a lot more work with them to make sure you're meeting their income needs for what they're doing going forward and make sure their assets remain intact throughout that period, et cetera. A lot different than you were when you were in the capital appreciation phase, where you can maybe check in with them once on a regular basis, see how their portfolio is doing. That's about it. So that's pretty much becoming the change in and of itself. But aside from those demographic changes, I've said on the show many times that I think options are the answer to this problem. If you're the advisor who's terrified about robo-advisors eating your lunch, stealing your business, stealing your clients, getting more fluent in options and how they work is a great way to shield yourself against that, because these are a little bit more time and knowledge and resource intensive products. But if you can commit that to learning how they work and how to implement them for your clients, it's not something that a machine can replicate. They can't really come out at this point and replicate a fantastic overlay type strategy and then manage it for their clients. They can't roll their puts effectively and things like that. It's just not viable for the machine. So if you come in and you become the options expert in your local region there, not only are you perhaps insulating yourself against this growing, rising machine tide in the advisor space, but also you can kind of raise your hand and make yourself set apart a little bit from maybe the 10 other guys in your area who are also financial advisors and who are also competing for that business. It's a way to kind of diversify yourself with the skill set that you could use going forward. So I've said that from the onset of this show, that's options are a fantastic way to do just that. And I think all these advisors are starting to come to that fruition and that realization now. Hopefully it's not too late for a lot of them. Hopefully their business hasn't already moved on. But if you are one of those advisors, I would certainly counsel you that a little bit of facility with options could go a long way towards keeping those clients and keeping those machines from encroaching on your business. Randy, anything to add on this one?
Just look at the basic concept of a robo-advisor is supposed to do. I mean, you're supposed to get access to low-cost ETFs and markets that provide some type of return. But let's be clear, what you're getting is a market return that's lower cost. And obviously, we think there's benefits beyond that Really what you do to have a building block in building a portfolio is beyond that basic efficient access to markets, you're still left with the basic concept of market risk and how you add to that portfolio, how you finish out that portfolio or round off that portfolio is really the value you're going to provide as an advisor. So in addition to the kind of financial planning and estate planning that you may do, adding an extra, notch on your wall of what you can actually do to say, hey, adding this into that basic portfolio is a way that you can improve your performance of your portfolio that you're not going to get from those. So yes, the robo-advisors cannot, they're not going to be able to recommend some of the stuff that, some of those boutique firms like us do. And that's what you got to do. You should be on the search for, something that's a little better or that's something that builds or finishes off a portfolio in a more efficient manner.
Yeah. If I could just add a couple points to that, because, the robo-advisors is an element of this paper we've been talking about. Two things. I mean, when it comes to robo-advisors, you get what you pay for. And essentially the value proposition of robo-advisors that investment advice is worth nothing. That's not what you're paying a robo-advisor for. So therefore, the quality of advice or investment solutions you get are going to be pretty cookie cutter. They're not going to be very robust. And the second thing is, oftentimes just use passive funds, they use index funds. And one of the knocks I've always had on index funds and passive investing is that passive investing can't play defense. I mean, if the market's going to go down 20%, you're going to go down 20%, 30%, 40%. I mean, by their very nature, you have tied yourself to the fate of the market if you're not doing anything active to address that. So if you're fine with that, then maybe robo-advisors is okay. But I think those two elements there, getting what you pay for when it comes to investment advice and being able to play defense, especially in times like this, that's when you really need a human being making decisions.
Well said, sir. I think we'll have to leave it there. Unfortunately, that's all the time we have for the office hours on this episode. It's also all the time we have for this episode of The Advisor's Option. But before we go, as always, let me check back in with each of my cohorts here on the old Advisor's Option program, see what they have cooking that may interest you. Mark, since you were kind enough to stick with us the whole program, I will start with you. I know you're always working on interesting new content over there at Swan. So if our listeners want to know about what you're working on, what's coming down the pike over there on the Swan website in terms of content, the blog, research papers, why don't you give them a few plugs here now? The floor is yours.
Well, sure. In addition to this Gordion Knot retirement conundrum piece, we also have a number of pieces talking about applying our strategy to a diverse set of asset classes. Swan was built originally around applying our strategy to U.S. large cap S&P 500 type stocks, but now we're covering emerging markets, small cap, developed markets. The basic concept works across all those asset classes, and the performance so far with all those products has been very good, year to date. In addition to that, my colleague Mike Wakefield is putting together a piece that's a little bit more robust and talks about the mathematics of investing and how it's more important to avoid those large losses and just catch a fraction of the up period. It provides you with a much better overall experience. So those are some of the things that just be coming from the brain trust over here at Swan.
I like it. The Brain Trust. Surf on over there to swanglobalinvestments.com to learn more, listeners. And Randy, before we go, a little birdie told me you guys are putting on a little conference coming up. You want to give our listeners a little bit of a tease, some insight into that?
And the first part of April this year, we're going to have a CIO conference down in Puerto Rico, one of the local hotels on the ocean. We're looking forward. We've got some great sponsors. I would rather not. I think that we've got some stuff on our website that talks about those conferences, but and who our sponsors are. But we have a great lineup, and we think it's going to be very informative, especially the way this year seems to be turning out right now. Another thing, Mark, that we did launch at the end of December, I think December 29th, we launched our small cap fund as well as our foreign developed fund. So now we've got 4 equity DRS funds out there that we're building our portfolio to ultimately give the ultimate cooks in the kitchen the choice to optimize and pick and choose on how they build portfolios that apply the same kind of defined risk strategy concepts that we've done historically with our S&P 500 fund.
There you go, listeners. Same thing. Surf on over to Swan Global Investments to learn more. And they couldn't make it on the program today. Our buddies over there at OIC are running around the country educating advisors hither and yon. So if you want to learn more about what they're up to, surf on over to their website, optionseducation.org. There's a lot of great research there that they do themselves, in addition to the stuff we break down here on the show. You can go find it all for yourself. So you're looking to arm yourself with some data when you want to sit down with one of your clients to explain to them why they should be using options. They'll have some data to back you up. And if you want to find it the best place, once you go over to the website, you'll see on the top right there the nav bar, Options for Advisors. Click on that, and you'll see all the data, all the resources you can use, all the studies, all the other fun stuff, all right there for you. Optionseducation.org to learn more. And on behalf of the OIC, as well as Randy and Mark and the Brain Trust over there at Swan, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. We'll get to more of them next time, I promise. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.